Hey guys, Freaky Finance here. Last week we looked at Vermilion Energy. Fairly international play. You get your Brent exposure, your WTI exposure, your European nat gas exposure, and your North American nat gas exposure. So again, had a lot of leverage. Today we're going to go into China because there's a lot of things happening in China over the last 6 months, and it's definitely heated up and continues to accelerate with this regulatory crackdown. There's lots of things that are screening cheap. This one I don't own yet. It's called Vipshop. Anyway, one of the things that I do just for fun is here all I have right now is a screener for China, and so FinViz only picks up 239 stocks that have entry with China associated with it. Then I click sort by market cap, so the largest at the top. And then what I do is I go 52-week high low, and I just go 50% or more below high, which means it's fallen at least 50% from the high in the last 52 weeks. You can see of the 239, 179 are below 50% of what they were at some point in the last 52 weeks, which is pretty crazy, right? During the COVID crisis in America and most of the developed world, shares only fell about 30% on the index level. But here you can see that the Chinese stock market is under a lot of stress, and it's leading to a lot of opportunity, I think, if you can handle it. All right, so you can see right at the top, you got Baba, Pinduoduo, Baidu. For reference, I own Baba and Baidu, and I'm thinking about adding Baba again. It's starting to crack 150, which is pretty crazy. P's won't be perfect. For example, PE still screens here at 17.44 for Baba, but honestly, it's about 15 because they did have that $2 billion fee US to the Chinese government in the last trailing 12 months. That also puts pressure on that PE, but really what I'm trying to do is say, is Baba, like, do I want to add to Baba or add to something else that's also getting crushed, because everything's getting crushed. That's kind of the thinking. And so when I go down, basically I'm still looking for profitable companies. That also helps filter this, right? And you can see some of these PEs are getting below 10. But anyway, today I decided to do one on Vipshop. Another way you can look at it if you're more chart orientated is just here, and you can see they all look fairly similar. Like, just peaked in March. Actually, Baba peaked the year before, and anti-IPO got pulled from them. But you can see common trend, right? Peak in the early part of the year and then crash pretty hard. And these are all, the screeners more than 50% decline from 52-week high. So they're all at least 50% cheaper than what they were at some point in the last year, which is pretty crazy when you think about it. And so what I'm trying to do is figure out which ones I want to buy. And ultimately I filter out the energy one, or not the energy ones, the education ones, because they're now not-for-profit companies. All right. So anyway, this is the outlet. It's a discounter. I'll kind of go into what that means in my eyes. This is the user interface anyway, and it's fairly similar to other e-commerce platforms that we've looked at. Just think of a discount retailer as someone who blows out inventory. That's their job. They'll take inventory and they just gotta sell it. The more they move product, the better. And usually doesn't have very good margins, because really you're buying product from the producer or manufacturer and you're just reselling it to move inventory as fast as you can. So usually that retailer that's selling you the goods probably overproduced it, right? And they're trying to get rid of it on their books, and you're kind of the guy that they go to get rid of inventory. That's kind of how I view it in my head. They do have a flash sales model. One of the things that's tricky in this kind of business environment is how easy is it for the people that are giving you the inventory to also do their own flash sales, right? Their own discounting. That's always a trick in this industry, but for the sake of this company, at least it's been around for quite some time. I actually have a lot of history of being a public company, and the accounting is actually not bad. I actually have a cash flow statement on the annual. They don't have one on the quarterly. Anyway, so this is the annual. They sell a lot of attire: menswear, womenswear, sportswear, accessories, skincare, right? Standard product offerings. Someone who manufactures a lot of these things, they built too much of it, it's building up an inventory. They're like, okay, we'll sell it to you at a discounted rate and you could resell it to other people through your channel. They do have like a little bit of segments, but I didn't break them out into segments because honestly, Vipshop online is pretty much the business. It's still 94%, right? So you talk about like having an offline presence, but if 94% of your revenue is through Vipshop.com, then it's not a big deal to me. On the brand selection, they kind of talk up how good they are at selecting their brands, selecting what they decide to buy and resell. But I did find this interesting on the consignment model for inventory, right? So consignment, basically, so the product would be sold by Vipshop, the retailer, in this case to the end consumer, but the ownership of the inventory is still retained on the supplier's books until it's been sold. So basically, Vipshop won't own the inventory until they sell it, still on the producers or manufacturers' books. And then they'll both recognize the sale, obviously. Vipshop recognizes its part of the margin, and the producer recognizes their part of the margin. So it's an interesting model. Usually that should mean that inventory is light, but when we go through the numbers, it's not necessarily true. Which is weird. So obviously it has its own inventory then. It's not all consignment, even though it says it right here, that inventory management is through consignment. But anyway, they claim that it's the only online discount retailer. I'm not familiar enough in the space in China, but it does look like they are the dominant one at the very least. And they try to differentiate themselves from the other large competitors. And these are the big guys, right? Alibaba was just over 400 billion. It was over probably 600 billion just 6 months ago. I think Pinduoduo was probably over 300 billion at one point. Now it's only around 100 billion. These companies gotten smacked, and so has Vipshop. Hence the opportunity or potential opportunity in the video. Their angle's kind of funny. Basically, they're saying the discount retail market doesn't exist, so they're all the only guy because no one else is really there. They're saying it's pretty fragmented. $1 equals 6.5 won. That's what I put in anyway. A lot of the Chinese companies, they'll put like the year over year in renminbi, and then only put the current year in US dollars. So I kind of do my own US dollar comparison over here just to make it easier for me. Now, this won't be exactly accurate because I'm not sure what renminbi they used, like what rate they used, and I assumed that it was 6.5 to try to keep the currency constant, but accurate enough for me to see trends. So you can see revenue continues to go up. And revenue's been going up a fairly decent clip, 10% a year, so not like Alibaba 30%, but still pretty high. And this is in US dollars, so they're making about $15.6 billion a year in revenue. So they're definitely not a small discount retailer. They're definitely attracting business. And here you can see the margins are about 20%. In the year-over-year comparison, revenue was up 10, but COGS was up 11, which is not great. That means margin compression. They did say that they did write down some inventory in the year, which is always a risk in this type of industry, and I think that highlights this here, is that if inventory sits, you're the guy who's supposed to get rid of it, and if you can't get rid of it, then you're going to be stuck writing it down. But again, their consignment model is supposed to reduce that risk, right? But anyway, it showed up here, which I thought was interesting. And they also gave free shipping on orders that were over 88 renminbi, and they have this super VIP membership that they're putting quite a bit of freebies into, really, to try to get the VIPs to keep spending more, because I guess they spend more per dollar, or they have a higher ARPU associated with them, which I guess makes sense. But when they do that, it reduces margins. This is the main source of scale, is this fulfillment line. So they're still able to generate $3 billion US in GMD, and $1 billion goes to just actually executing on the orders. Now, this is the negative that we keep seeing in China year over year, is that they're all spending an awful lot more in marketing expenses in 2020 than they were in the past. When your marketing expense goes up 28%, but your revenue only goes up 10%, kind of a thing, right? You're supposed to outscale your marketing as you go, not the other way around. But this isn't just a unique trend to this company. This keeps coming up, especially over the last COVID year in China. And they all say that they're fighting for new customers and retention of the existing ones, which is interesting, right? Because they're all doing the same thing. They're all just spending more money. But really, what I kind of want to do now is look at where are they marketing on, right? Because they probably made a killing last year, and they're probably going to keep making a killing, because I don't see the industry getting less competitive with these regulatory crackdowns. This is another source of scale. I did look at the notes on this one because I was like, why is IT going down quite a bit, right? Down 22% on 10% more revenue. And they do mention scale, and then they also mentioned reduced headcount in the IT department. So they lowered the amount of IT support there. But to be fair, 2019 was high for IT support, so it's kind of a bit of a noisier year-over-year comparison. And again, they show good here on the G&A, and they mentioned that 2019 though was higher than what it should have been, versus 2020 is more just normal because they had severance pay in 2019. Other operating income is interesting. The only comment on their annuals was they're getting about 100 million back in tax rebates a year, and this is steady. So this is like over the last, I don't know, so many years, they're always getting around 100 million US in tax rebates, whatever that means. So operating income's pretty good. You're at 900 million US, and then you have quite a bit of noise for investments right here. They don't pay interest, they actually earn interest, which also increased. Their investments also revalued higher, because 2020 was actually really good for China versus 2021, where we are now, where it's just really bad for China. So one of the things that I don't own this company yet, and why I haven't yet added to Baba, but I really want to, because my average cost is 198. Eventually take it up to a 5% position. Right now I have it at a 2%, so I'm just trying to figure out, should I slowly keep adding or what, right? One of the things that's holding me back is this net investment gain, because all these guys mark to market their value of their investments, and all the investments that they have are in each other, and they've all gone down 50%. So what I'm hoping is that when they report their numbers for this next quarter, because it's about to end September 30th, when they report sometime in October or November, they're going to have all these fairly large revaluations, lower income. It's not operating, so technically it shouldn't matter to the market. But when they see the media is going to report these really bad earnings per share because they're all going to revalue lower their investments in each other. And so what I'm hoping is that it makes it even cheaper. But at the same time, a lot of these companies have been destroyed. Like, we're talking not just 50%, we're talking 60%, 70%, 80%. It's actually really crazy. There's just, everyone's getting out of China. Like, even, like, you remember there was 230. There's still 64 Chinese companies of the 240 that are down 80% from their 52-week high in 21. So 10% are 90% below their 52-week high. Again, these are a lot of these education ones that literally are no longer able to make profit, so therefore the equity should be getting screwed. But that tells you the regulatory risk, and it's basically the market's trying to be like, okay, you're going to do that with your education, you're going to do that with everything else, right? And you can see that's why this is happening. But yeah, I guess all I'm really trying to say is that these revaluations higher in investments should also reverse given the crash that we've seen, and it should start showing up in the quarterlies pretty quick here. And again, it's not operating, but it's something that I think will impact at least how the media reports earnings per share. Now the company will too, but non-operating doesn't really matter. It's just a reflection of the whole market going down. Assuming their investments are in China, which a lot of them are. They all just invest in each other. Anyway, you can see the share price is actually cheaper now, which is why I'm doing the video. At the end of 2019, December, it was at $14.80. This share price was actually just at $46, like, God, I don't know, 7 months ago. And now it's at $11.96. So that's a fall of about 70%. So it's 70% cheaper than it was at some point in the past. But even if, say, realistically the price should have never been over 35, you're still getting quite the discount, right? You're getting a 66% discount on a discount retailer. Fully diluted share count did tick up year over year. They have started buying back shares because they do generate cash flow. They are a profitable company. I'm hoping this continues, especially at these low prices. They're getting quite a lot more out of their buybacks given where the share price is at these levels. So the equity market cap, technically the company is about, here it reports 50% better, but if I back out the income from investments, get about 150 million better, which isn't small. You're still up quite a bit, but not 50%, probably more like 20% better in profitability. But the share price is down about 20% relative to where it was in prior year end versus now. Ultimately very cheap relative to where it was just 7 months ago. But anyway, you can see the tangible assets. Not bad, right? 9 billion. 1.8 billion of that is cash. It does have a fairly light PPE model. AR is very low at the cutoff. Again, these are just point in times at December 31st year end. So it was kind of weird that I saw AR go down about 80%. So luckily, we already know that Q1 and Q2 were decent for sales. So it doesn't imply that sales were weak. Just might have just been the cutoff. Now the inventory is, for someone that has, say, inventory on consignment, it's I don't know, in my eyes, kind of high, right? 1.1 billion in inventory for a discount retailer that's not supposed to have any. No, the debt is very low. They are, like I said, kind of captures it up here, net interest income. So it's actually, they bring in more interest than they pay creditors, and they do not have long-term debt anymore. It did shift to short-term debt, and honestly the liabilities, they're dominated by AP and AL, accounts payable and accrued liabilities. And you can see total equity continue to go up because the company is profitable, because retained earnings keeps going up. Cash flow is actually pretty strong, but there's a lot of working capital swings in here. It's nice that they showed the cash flow statement, and it's actually detailed, which is different. But they don't do it on the quarterly, and they also have a lot of noise in here. They like throw everything in there. It's hard to break out what I want. So this isn't perfect either, right? I'm like, why does the company still have a steady CFO if the company's at least 150 million better in terms of gross margin dollars? Here, in terms of operating income, you can see, right? It should pick up. It should correlate with each other, but this time they don't. But again, there's these huge inventory and AR swings in here. Massive. Free cash flow, you can see pretty high, 1.4 billion US dollars. And they did park some of that cash into short-term investments. And I'm hoping, because there seems to be a redemption cycle, so I'm hoping once they redeem, they're going to use them to buy back their own shares because of how cheap they are. Just for reference, down here you can see PE is now under 10, had it at 9.1. I think other things have it at like 7.9. But anyway, it's below 10. It's cheap relative for earnings, and it does make money. COGS inventory improved, so that's good from operations. This is the thing that threw me off, and we'll go through the last quarter call in a second. But you can see total active customers year over year for 2019 versus 2020 improved 21%, but revenue only grew 10%. So, like, okay, how do you get 21% more active customers but only grow 10%? That means the people you attracted aren't spending as much, or at least that's what I think. Margins did start coming down. We talked about that. scale is still there in fulfillment as percent of revenue. Marketing is actually going negative. They're spending more to get a slower growth rate. And the profitability is not that great, right? You're only getting 5% of what you sell at the bottom line. So they're able to attract more customers, but so far these new customers haven't been spending to the same level as the old customers. And then earnings per share looks good because the underlying operations did improve year over year. And here's kind of my little comment to myself at the end. These are all kind of things that I write as I go, but I'm kind of reiterate that I'm hoping that the next quarter investment should be bad for all the companies. So I own Baba. I picked up Tencent around 59. I kind of want to pick up Vips as well, but again, I don't want to get in front of this non-operating investment noise because they should all get hit real hard, right? If they mark to market this next quarter, they should just get smacked because these companies have all collapsed with the regulatory crackdown. It should show up in the mark to market on the investment side, which is exciting for me if the market reacts even further. Though again, some of these companies are already down like Great Depression levels. Like we're talking 80%, 75%, like this company from 52-week high. So it's getting really exciting from my angle in China. All right, let's jump back into it. So this is just the quarterly trends, and you can see gross margins has been steadily around 20. Fulfillment side, this is the part that they're actually scaling. You can see that here. It shows up pretty good in the numbers. But the decline over time as sales keep picking up, they actually are improving on operations. This is their main cost item, so that's important. But on the offset, their marketing's picked up, and it's not just picked up small. Like they look small, right? You're nitpicking, right? 3.2 to 4.7, but that's a 50% increase in marketing expenses, and their margins are only 5%, like the profitability, the bottom line. So they're saving in fulfillment, they're spending in marketing. And then G&A has been flat. 2019 was an outlier because they had those severance packages that I talked about briefly. And then you can see the profitability. Well, it has improved. It started to dip back down again, and I think that's also putting pressure on the stock. And you can see how razor thin it got in 2018. Just for a trend, you can see the profitability has continued to slowly improve, going from 24 cents a share in earnings to 42, 51, 86. $1.34. This was COVID, so obviously more spending was happening online. So that could be another thing that the market's trying to get in front of. You can see the growth rate's more interesting to me. You can see it going in like almost 100% and going, 30% and going maybe 35%, 10%, 10%, 10% growth. So you can see that, and these, well, they're not small numbers, right? But they're not growing like they used to be growing. Does that mean that more of their suppliers are discounting themselves, right? They're pushing inventory out themselves. They don't need this company as much as they used to because the other competitors like the Babas, JDs, are still growing at higher clips than 10% a year. But yeah, you can see that underlying business has improved year over year fairly consistently over time. So the company's been managed well. It's just you don't know how strong of a moat they have because their business model relies on people to give them inventory, really. Share repurchase, like I said, they started to buy some. Hopefully they buy more. They bought 301 million of their 500 million they have allowed. And the other guidance was kind of weak. They said a growth rate between 5 to 10%. And they were growing historically 10% for the last 3 years anyway. So at a lower growth rate for the third quarter. Lately, it got hit pretty hard this week, and that's why it drew my attention while I'm doing the video. There's an analyst, JP Morgan, downgraded this from 22 to 11 after, obviously, the move happened. So I look at this as like a contra buy signal when this happens. So analyst this was worth 22, and it slowly went against him, and then he capitalizes. But I do think his thinking here is interesting, right? Usually analysts follows the company closer than I will. Only about 5% year over year for the second half, with margins to drop further. So we'll have to see if that's true, because this report did knock down the stock about 10% that day. It bounced back a little from 11.50. Actually, I think it hit like 11.30 or something that day. This will be good, right? I want to see it. Is he right with Q3? Because I think Q4 will be better, and then I get this investment mark-to-market noise out of the way. Same time, these companies won't screen as cheap if they don't back out the investment noise. This is just the guidance on the quarterly cadence. You can see down here, they're saying Q3 is usually weaker for us anyway. Usually Q4 is good for peak season with apparel, ticket sizes increasing, so more ARPU per user. And this guy kind of talks about the revenue guidance and the ARPU, as well as the sales and marketing. And this CFO, he keeps talking about the marketing expenses as a way to get the customers. And that's true, they have been growing their active customer base. We saw it in the annuals. This has continued in the quarterly. Is the active customer base. It's up 32%, but the revenue isn't growing 32% anymore, right? So they keep attracting more customers, but the customers aren't spending the same amount of money. So that's kind of an interesting dichotomy here. That's a pretty big disconnect. If you're only going to grow 5% in revenue, but you're growing 32% in your customer base, it's like, okay, what's going on there? Their idea is to get them and then get them to spend more once they're there. It's kind of how they're thinking about it. And if it works, it'll be really good. If it doesn't, it looks bad right now, right? Because their spending's increased and the revenue's not yet coming in, even though their customer count is increasing. The angle here, they kind of talk about the ARPU, like why is it going down per user? Since they're so good at attracting more customers, why aren't they spending money, right? Or as much money? So they say it takes time to spend. That's kind of like their answer, that they've attracted them and then they'll start spending more as we go. So I'll have to see if that's true. It would have been nice if they had some real numbers, like they spend 10% more every 3 months that they're still active on the platform or something like that, right? But they don't really give anything other than this kind of qualitative answer, which is fine, but it doesn't give me like, okay, when will they spend more, right? That's what I want to know. You're obviously attracting them, but they're not spending anything. And again, CFO here, I just want to reiterate it because he keeps bringing it up that they're growing the customer base. So they're saying, yeah, we got them now, and then we're gonna get them to spend more. That's their angle anyway. So it's an interesting company. You can see their stock chart just go crazy, right? So where's the COVID panic? Can't even see it on this chart. First 2020. Technically in China it was a little bit earlier. But even here you can see it was a $13 stock going into COVID. And it's been steady climbing up because e-commerce has been good. The business has been performing well. And then they did get better at their fulfillment expenses. So some of this makes sense, and then some of it's just bubbly, right? So even this, there's probably this $30 to $45 move was probably fake. So even if I say realistically the stock's max probably only worth 30, right now it's at 12, right? So I'm getting pretty good odds because the company is better than it was. But you can see when the margins were razor thin last time around in 2018, this company got hit really hard, right? We're talking $5.70 a share, even less than that. That's why I haven't pushed the button yet, because I'm like, well, should I buy this company, which is cheap, or should I buy Baba, which is also cheap and growing and fairly dominant, right? So I'm kind of on the fence on this one. I keep going back to it, but it keeps getting cheaper every time I look at it. But yeah, it's an interesting time to try to put some money into China. But I'd like to know your thoughts, and have a great rest of your week.